It started as a non-profit whose mission was to benefit all of humanity. Now it's preparing to list on the stock market at a valuation above $1 trillion, while losing billions of dollars every single year. This is the story of the most controversial IPO of the 2026 bull market. OpenAI, the company behind ChatGPT, is preparing to go public as early as September 2026. Goldman Sachs and Morgan Stanley are leading the deal. The target valuation sits above $1 trillion, against a private market valuation of $852 billion just months earlier. The commercial story is remarkable. OpenAI's annualized revenue run rate crossed $20 billion at the end of 2025. That's one of the fastest revenue ramps in corporate history, but the financial reality underneath that growth is where it gets messy. OpenAI is burning cash at a scale that's genuinely hard to comprehend. Projected losses for 2026 alone are estimated in the billions. Annual compute spending, the cost of running and training AI models, is on track for hundreds of billions cumulatively before the business turns profitable. And break-even? Most credible timelines say 2029, at the earliest. So you have a company worth over $1 trillion that won't make money for at least 3 more years. And that's the optimistic scenario. Wall Street is being asked to buy a narrative, not a balance sheet. OpenAI was originally founded as a nonprofit in 2015. The idea was simple: build artificial general intelligence safely for the benefit of humanity, not shareholders. Elon Musk was a co-founder. Sam Altman joined as CEO. They raised money from donors and operated with a research mandate. Then the compute bills arrived. Training GPT-4, building ChatGPT, scaling to hundreds of millions of users, it all cost money that a non-profit model couldn't sustain. So OpenAI restructured into a capped profit company, brought in Microsoft as a core partner, and started raising private capital. The non-profit mission quietly became background noise. Musk sued. He claimed Altman and the board betrayed the founding principles. The trial ran for 3 weeks in Oakland in 2026. In May, a jury dismissed all of Musk's claims on procedural grounds, not on the merits. Musk is appealing. But for now, the legal cloud over the IPO has lifted. Top analysts on Wall Street are already drawing uncomfortable comparisons. Several have described 2026 as looking like 1999, a period of extreme optimism about transformative technology, followed by a brutal correction when earnings failed to materialize. Here's the honest question investors should be asking: is OpenAI's $1 trillion valuation pricing in a future that's already guaranteed, or is it pricing in a future that's merely possible? Because those two things are very different. The company's dependence on Microsoft, intense competition from Google, Meta, and open-source models, and the sheer cost of scaling AI infrastructure all create a risk profile unlike any company that has gone public before. Here's the capital lesson. The most dangerous investments are the ones where the story is so compelling that people forget to ask hard financial questions. OpenAI's story is genuinely one of the most important in modern history. But important and profitable are two completely different things, and the IPO market has a long history of blurring that line. Watch this one carefully. If you want more breakdowns like this, subscribe, hit the bell, and share this video with anyone who's thinking about buying into the AI IPO wave this year. OpenAI is burning cash at a scale that's genuinely hard to comprehend. Projected losses for 2026 alone are estimated in the billions. So, you have a company worth over $1 trillion that won't make money for at least 3 more years. Annual compute spending, the cost of running and training AI models, is on track for hundreds of billions cumulatively before the business turns profitable.